Hello everyone, welcome to session 4. In the last session, we learned about how to find out then standing capital ratio, which will help us out in sharing the capital deficiency of an insolvent partners by the solvent partners. In this session, I am going to discuss about the accounting entries regarding dissolution of firm. The first one is for transfer of asset. And remember, while transferring, we are not supposed to transfer the cash, the bank balance, as well as if there is any loss on the asset side of a balance sheet. For this one, an entry should be passed like this. The first entry is realization account debited to sundry assets account. So while transferring, realization account need to be debited with each asset getting credit. If there is a machinery, realization account debit to machinery. If there is a building, realization account debit to building. If there is a furniture, realization account debit to furniture account. So hence I have written in the bracket assets with their names to be transferred. So this is the first entry. Second one is when liabilities are transferred. And remember, while transferring the liabilities, you are not supposed to transfer the capital balances. If there are current account balances, general reserves, if there is a P&L account, reserve fund, and if there is any loan account, then what is the journal entry to transfer the liabilities to realization account? The entry would be sundry liabilities account debit to realization account. So all the liabilities will appear on the credit side of realization account. Then the third entry is for when assets are sold for cash. When assets are sold for cash, then the entry would be cash or bank account debit to realization account. Here, at what price the asset is sold should be recorded, but not at the book value. The next one is when asset is taken over by a partner. When the assets are not sold in the open market, but it is taken over by a partner, then the partner's capital account debited to realization account. So this entry is for the assets taken over by a partner. And the next one is if the liabilities are paid off. Entry number 5 is liabilities transferred to realization account are paid off. Then the journal entry would be the realization account debited to cash or bank account. So this entry is for the payment of liabilities. And entry number 6 is when some of the liabilities are taken over by the partners or a partner, then the entry would be realization account debit. That means to say with the amount agreed value by a partner. At what value the partner has agreed to take over a liability. For that one, realization account debit to partner's capital account. Then entry number 7. In the process of dissolution, we are going to incur some expenses in realization of assets and payment of liabilities. Then if we incur any realization expenses, then the entry would be realization account debited to cash or bank account. So this entry is for the payment of realization expenses. Then look at entry number 8. When after transfer of assets as well as liabilities and after sale of asset or asset taken over by a partner as well as the payment of liabilities or a liability taken over and the payment of realization expenses, we go for balancing of realization account. When you balance a realization account, if it is depicting a credit balance, then it shows that there is a realization profit. So hence the entry would be realization account debited to partners capital account. So you will be having the realization profit, and this profit to be distributed among all the partners of a firm in their profit sharing ratio. So entry is realization account debited to partners capital account. If we have realization loss, that is entry number 9, when realization account shows a debit balance, then how? Then entry would be the reverse of entry number 8. Look at entry number 9 is partners capital account debit to realization account. So if there is a realization loss, this loss to be transferred to all the partners in their partners capital account in their profit sharing ratio. The next one is entry number 10. When a partner pays realization expenses, then realization account debit to partners capital account would be the entry when the realization expenses are borne by a partner. The next one is when a partner acts as an agent of realization of assets, the entry for his commission, then realization account debited to particular partner's capital account. The person who is acting as an agent for realization of assets, his account need to be get credited by debiting the realization account. The next one is, remember I have given some note, important note. Remember, sometimes liabilities are not transferred to realization account. Under such case, the liabilities are paid off directly. In case if there is any profit or loss, the amount of such profit or loss only will be transferred to realization. Remember, sometimes instead of transferring a liability to realization and going for payment of it, we directly pay the liabilities. If you go for payment of liabilities directly, then if there is a profit or loss on such payment, only that entry should be passed in realization account. Then how that entry is going to be passed? Look at entry number 12. Sundry liabilities account debit, realization account debit to cash or bank account. So this is for the liabilities paid off and the loss transferred. And the next one is 13. Entry number 13. When liabilities are discharged for amount less than the book value, then see, if we are supposed to make a payment of 10,000 and a creditor agrees to receive only 9,000. So we are making a profit of 1,000. That is the meaning. So at that time, how an entry should be passed? The entry is sundry liabilities account debited to cash or bank account to realization account. So this is for when liabilities are discharged less than the book value. I gave an example. The book value of creditors is 10,000 and creditors agreed to receive a payment of 9,000. We have done a settlement of creditors at 9,000 and we made a profit of 1,000. So that is an example. The next one is when partners' loan are discharged, then partners' loan account debited to cash or bank account. After this, we are supposed to transfer if there is any undistributed profits available in the balance sheet. First one is if there is a general reserve account to be debited. If there is a separate reserve fund account, that reserve fund account to be debited. There is a P&L account showing a credit balance that should also be debited, and all these three undistributed profits to be distributed and transferred to partners' capital account. And the next entry is if there are losses, if there is any undistributed loss, it is an opposite entry. Here the partner's capital account will get debited and concerned loss account is going to get credited. So entry is partner's capital account debited to profit and loss account. Then entry number 7, when the deficiency in the capital is brought in by a partner, the entry would be cash or bank account debited to partner's capital account. The shortage of capital brought in cash by the solvent partners. The next one is balance of capital accounts of partners when they are paid off. Remember, at that time the partner's capital account debited to cash or bank account, and this entry is for partners' capitals are paid off. But as we are learning the dissolution due to insolvency by applying the rules of Garner versus Murray and the decisions given under the Garner versus Murray, as we know that if there is any deficiency that should be brought in by the partners, we have just now learned according to the decisions of Garner versus Murray. Remember, if there is any realization loss, if there is a realization profit, partners need not bring anything in the form of cash. But if there is a realization loss, then according to the decisions of Garner versus Murray, the solvent partners have to bring in cash equal to their share of realization loss. Then what would be the entry? The entry is cash or bank account debited to solvent partners' capital account. And remember, if there is a realization loss, only solvent partners have to bring in cash, but not an insolvent partner. That is what is being dealt, or the decision given in Garner versus Murray. Please make a note of it. And the next entry is sometimes an insolvent partner will be in a position to bring something from his private estate. If an insolvent partner is able to bring something from his private estate, even for that also we need to make an entry, that is cash or bank account debited to insolvent partner's capital account. After these two, remember the Second, decisions of governance merit state the deficiency of an insolvent partners should be borne by solvent partners in their then standing capital ratio. Then, what would be the entry for the capital deficiency distribution? The entry would be the solvent partners capital account debit to insolvent partners capital account. So narration is being capital deficiency borne by solvent partners. Friends, hope I have discussed all the journal entries relating to insolvency of a partner, because of which a firm will undergo dissolution. So I have quoted the references. In case if you have any doubts, you can refer the references. Thank you.